Risk management and asset allocation are, really fundamental to building and maintaining a diversified investment portfolio. By aligning investments with your objectives, your own risk tolerance, and the current market conditions, investors can actually optimize returns while mitigating risk. Employing strategic, tactical, and dynamic asset allocation strategies, along with regular portfolio rebalancing, helps manage exposure to changing market conditions and honestly ensures long-term financial stability. Key concepts in risk management and asset allocation. Role of risk management in asset allocation. Setting investment objectives means defining your goals, like income generation, capital preservation, or growth, to guide your asset allocation decisions. Assessing risk tolerance means, figuring out just how much risk an investor is both willing and able to take on. This depends on their financial situation, how long they plan to invest, and honestly, how comfortable they are with the ups and downs of the market. Balancing risk and return is all about, allocating assets in a way that strikes a good balance between those higher risk, higher return investments and the more stable, lower risk assets. Types of asset allocation strategies. Strategic asset allocation means, establishing a target mix of asset classes, like say 40% real estate, 30% equities, 20% fixed income, and 10% commodities, based on your long-term goals and your risk tolerance. You basically maintain a relatively static allocation over time. Tactical asset allocation is where you adjust allocations periodically to capitalize on short-term market trends or opportunities. For example, you might increase equities during bullish markets or shift towards defensive assets during downturns. Dynamic asset allocation involves continuously adjusting portfolio allocations in response to market conditions, risk exposure, or changes in financial objectives. This approach allows for more flexibility in volatile markets or, uncertain economic environments. Rebalancing investment portfolios. Why rebalance? Over time, market fluctuations can cause actual portfolio allocations to drift from target allocations, increasing risk exposure. Rebalancing frequency, you should perform rebalancing quarterly, semi-annually, or annually to realign portfolio allocations. Rebalancing methods include reallocating capital from overperforming asset classes to underperforming ones to maintain target weights. You can also use new investments or income to realign without selling existing assets.